level, we talked a little bit about the ultimate trading pattern, the Gartley pattern. In this session, we're first going to look at the background of H.M. Gartley, his classic book, Profits in the Stock Market, and how the Gartley pattern has evolved over time. First, let's meet the man, H.M. Gartley. So who was H.M. Gartley? H.M. Gartley was born in 1899 and he lived till 1972. He was the publisher of Gartley's stock market data and was well respected on Wall Street. In fact, he knew Jesse Livermore and worked with Ben Graham at Columbia Business School. If you don't know who Ben Graham is, he had a huge influence on Warren Buffett. H.M. Gartley was also one of the founders of the New York Society of Security Analysts. After World War II, Gartley got into the public relations business, as it was known at that time. Then he retired and died in '72. The Market Technicians Association gave Gartley their annual award after his death. Harold Gartley, according to some sources, referred to his operation on Wall Street as one of the best equipped laboratories in Wall Street. Here's a graphic of what his newsletter looked like. In addition to publishing the newsletter, Gartley trained a number of prominent Wall Street traders with individual lessons that were part of a loose leaf binder that he used as part of his education. This binder eventually became published as a single volume entitled Profits in the Stock Market in 1935. What's really quite interesting about Profits in the Stock Market is that this book was very expensive at the time. It was $1,500, and in 1935, as you know, there's a depression in the United States, and to charge that much money for a book on the subject of something as unpopular as the stock market, it seems crazy. But he had a picture of a pattern on page 222, and this is what he had to say about that specific pattern. He called it one of the best trading opportunities, and he said this: in 8 out of 10 cases wherein each of these conditions occurs, a rally which will provide a worthwhile profit ensues. In the other 2 cases, only small losses have to be taken. This information got my attention. I heard about this really expensive book that someone was charging for in 1935, and then it was stated that you'd win more than you lose, and when you do lose, it's not catastrophic. Gartley refers to the losses as being small. Now, it seems outrageous that someone back in 1935 could tell you that you're going to have small losses, and it's all in proportion of what your risk is compared to your reward, so we'll be looking at what he meant by that. So here's a picture of what was on page 222. As you can still see here, the page number. This is what Gartley referred to as one of the best trading opportunities. Now you notice over here on the left is a bullish example of one of the best trading opportunities. Okay, so example A here, we have A, B, C, and here's a buy with a stop over here. So a stop just below B. He also gave a bearish example here on the right. Once again, the labels A, B, C. A retest of the high here. You sell short here and you put your stop here. So this is a real picture from the book. Compliments of the Jones family at wdgann.com. And they are still publishing this book. So if you'd like a copy, get in touch with them. Now, one thing that we'll notice, there's an evolution of the Gartley pattern over time. Maybe you know something a little bit about the Gartley pattern already, and what I just showed you didn't make any sense whatsoever because it doesn't look anything the way it is today. So let's go through how the pattern has evolved over time. And one of the things that's missing today that I'm going to reintroduce you to are the volume rules that Gartley used in reference to one of the best trading opportunities. So over here, once again, we're using the exact same labels that Gartley used. We have the Dow Jones Industrial Average here on a daily chart. Here's label A, the high. Here's B, the low. But in reference to this pattern, he said, the first thing in regard to volume, he said, activity has shown a definite tendency to dry up. So what I've done here is I'm showing you volume on the bottom of the screen here, and I've drawn a trend line to show how there has been a decline in volume going into this B label here. So that was one of the criteria that Gartley referred to in regard to his pattern. Now, what else? We see a rally. What does he have to say about volume next? He says the tendency is for the volume to dry up here, but then he says with volume expanding on the upside, okay, so from the B to the C, we want to see a pickup in volume here. So notice the trend line is moving up on the volume. And now let's see what else he has to say. So the volume dries up and then it expands, and then it says with volume drying up again. Okay, so as we're going down into this bullish Gartley pattern, we'll call it Gartley's Gartley here, we have to see a decline in the volume as the market moves down here. So it's really quite simple, the volume rules, but they're really important in the sense that no one uses them pretty much in regard to what are referred to as Gartley patterns today. So this is specific information relating to the original material that will help us find better Gartley patterns. The other thing that he mentioned too was that the market would, in this case, have a retracement. He didn't use the term retracement, but as it declines here into a bullish pattern, he expects it to decline from a third to a half of this range from B to C. So he didn't talk about Fibonacci ratios. Wall Street wasn't using Fibonacci ratios yet. So we see here a lot of people maybe have made the mistake thinking that Gartley was using Fibonacci ratios, and he was not. He simply said a third to a half. And he said with the volume drying up, this would be a place to buy, and that you would put your stop over here at B. Let's fast forward here a little bit to the 90s. Larry Pesavento is the first one to really make this pattern popular in the public eye. I know Larry personally, and I've talked to him about this, and he said it was when he met Don Mack at the investment bookstore in Los Angeles, and he asked Don which book was the best to read of all the different books, and he said the Gartley book, the Profits in the Stock Market from 1935. So Larry took the book and ran with it, and then he published a book entitled Astro Cycles, A Trader's Perspective in the 90s. And in that book, Larry shows something very similar to the original Gartley material. So over here on the left, we have a sell signal. The labels are a little bit different, but we have a very strong rally. And then he says there's A, B, C. Now also, this corrective sequence here looks very much like the original picture that Gartley had in 1935. This zigzag correction. We talked about this type of symmetry between these two legs here when we're discussing extensions, price extensions. So what he's done here is he's duplicated that information and made it clear that that's what he's looking for on the BC leg. And this would be the sell signal. And over here he's got an example of the buy. So we have the decline, significant decline to A, rally to B, once again the zigzag between B and C. Now after Astro Cycles, Larry published Planetary Harmonics of Speculative Markets. And in this example here, in the green square, he has a picture of what he calls a Gartley pattern, and now he's changed the labels where we have X, A, B, C, D. And so the other thing that's missing here from the previous illustration, the significant leg down for the bullish trade setup is gone. So now he just refers to this pattern here as the Gartley pattern. So he labels as X, A, B, C, D, and in addition to that, he's now focusing on the symmetry between the AB equals CD, and that's where we get the terms AB equals CD. He's the one that has put that out there, and people are talking about that a lot these days. And he also talks about the retracements based on the XA move. So here's X, here's A, and so he starts to draw Fibonacci retracements based on the XA leg. So that's what these green lines are here. This would be a 61.8% Fibonacci retracement, and this one here would be a 78.6% Fibonacci retracement. So Larry changed it a little bit here. He's removed this leg, he's put different labels on it, and now he's adding Fibonacci ratios to the Gartley pattern. So he pioneered the use of Fibonacci retracement levels with the Gartley pattern. So here we have the Gartley pattern late 1990s, called the G222 according to Larry Pesavento. He called it that because you notice over here it says 222. That's the page number of Gartley's book, Profits in the Stock Market, where this picture appears. Now remember, here's the bullish example on the left-hand side, and now we've narrowed it down to just what's inside this small box here. We changed the labels around a little bit. We've redefined this last leg down so that it's got this AB equals CD structure, and we are now also calling this first leg up the XA move, and we're drawing Fibonacci retracements on it, and we're not using the retracements that Gartley used. Remember he said 1/3, 1/2. Now we're using 61.8% and 78.6%. So this is what the Gartley has evolved into. Now, when people discuss the Gartley pattern, this is primarily what they're talking about as shown in the previous slide. See what's inside this box here? We have a trend, which would be this green line here, followed by a counter trend, which is that AB, BC, CD, all this corrective price action here would be the counter trend. So we're looking to be a buyer at point D with what I call a trend continuation Gartley pattern. After looking at Gartley patterns for a while, I make it clear in the Gartley Trading Method book that there definitely has to be two categories of Gartley patterns. There has to be a trend continuation Gartley and a trend reversal Gartley, because if you look at the original material, remember that previous leg before what we see in the box here, where before the X point, there was a significant trend move prior to that that has vanished, that people don't really talk about these days. Now if you look at the original material, it looks like a trend reversal, like a retest of a significant higher low, like a double top, double bottom. Even Gartley himself says this is going to look like a double top, double bottom, or head and shoulders, regular or inverse. So Gartley's Gartley was more of a trend reversal Gartley, but most people, when they trade a Gartley, they're looking at what's inside this box here, and so it could be a trend reversal or a trend continuation. So look at this. This would be an example of a trend continuation Gartley, because rather than the trend coming down and reversing at a significant low here at X, most people would just say, well, as long as there's some sort of corrective look prior to the X leg, doesn't matter if it's trend reversal, trend continuation. As long as I get what's inside the square, I'm good to go. That's pretty much true in the sense that if I got something that looks corrective here, and what precedes that looks like a trend, this could very well be a trend continuation Gartley pattern, because look at this. You got a trend, counter trend, trend, counter trend, and the assumption is now what? we assume that the trend's going to reassert itself and go up and make a new high. So we'd be a buyer right here. That's a good trade for you. So this is an example of a trend continuation Gartley. And we see this a lot even with Elliott wave. See this screen here, there could be a trend. We know that a 5-wave sequence in Elliott wave terms could look like this, a trend followed by a counter trend. So you'd be a buyer here. You really don't even have to worry about what the Elliott wave count is. You just look for the end of one of these corrections and you buy. So there's a Gartley pattern right there. But notice there's also one over here. There's a trend followed by a counter trend. Boom, you'd be a buyer there. There's another Gartley pattern, a trend followed by a counter trend. Yep, so this is one of those trend continuation Gartley patterns. And of course, the whole thing is a Gartley pattern, as I mentioned. Trend, counter trend, buy right there. In the Gartley trading method, going back to Gartley's Gartley, I wanted to reintroduce the public to the original material and say, hey, there's a Gartley pattern that is a trend reversal Gartley pattern. So there's two types. The one on the previous slide, or the one just before the Elliott wave slide that we looked at, was the trend continuation Gartley pattern. This one here is a trend reversal Gartley pattern, very much like in Gartley's original material. Remember this downward leg that we saw with the bullish example in Gartley's material? It comes down from a high down to the low. We'll label it X, like Pesavento did. And then from there we have a rally. This XA leg, do you notice how this rally here is bigger in price and time compared to the other swings that you see over here? So you got a bit of a rally here, a bit of a rally here, and this significant one right here. That implies that maybe we have a low right here at X, but we're not sure yet. The only way that you're going to know that for sure is by, well, even then you're not going to know for sure, but what you want to do is after this trend leg, you want to find out if there's the market action after the A point here looks corrective in nature. So look at this, AB, BC, CD. We got symmetry between AB equals CD. It looks like maybe this could be a trend reversal Gartley pattern right here. Remember Gartley said 50%, a third of a retracement. We look for the volume. Remember, a decline in volume, increase in volume, and then a decline in volume. That would be closer to what the original Gartley pattern looked like. Now, in the Gartley trading method, I identify a leg prior to the X point, this move here, as the WX leg. I just call this W because that's the letter before X. But what it does, it's just a label to identify this trend move prior to the Gartley pattern that most people refer today as a Gartley pattern over here. So let's look at this again. A TRG, which stands for trend reversal Gartley, first includes a WX leg. So here's W, here's X. We have a significant downtrend here. We're looking at a bullish Gartley pattern inside this box, but prior to the X point, we have a significant down move that of course is going to be higher than this A point. And if you like Elliott wave, you're probably going to see some sort of 5-wave sequence in here, but I just call it WX. I'm not looking for any subdivisions within the WX leg, but this move has to be above A for sure. And it must display some sort of trait of a trend move versus a counter trend move. If you have the WX leg, then we start getting into our traditional Gartley pattern, which is the XA, which we think is an establishment of a new trend going against this downward trend. Why? Because this leg is bigger than this one and this one over here. Now following that new trend leg, we're looking for a counter trend move, and what does that look like? We want to see symmetry between AB equals CD. or if you're an Elliott wave trader, you want to see some sort of symmetry between wave A and C of this counter trend move. And ideally, this we're hoping is wave 1, wave 2, and it turns into a big wave 3, goes off the map here. And remember, Gartley said when you do lose it's a little bit of money. This is what he meant. He meant if this is a deep retracement and it gets around 78.6% retracement, for an example, you put a stop over here at X, you're not really risking much money here compared to the potential if this turns into a wave 3. So my favorite is the trend reversal Gartley, the TRG. That's the one that I know and love the most. And also, in addition to what we see here in the way of a structure, we also want to plot volume at the bottom of the chart to make sure that that volume is conforming to the original Gartley rules that we looked at earlier. The other thing that's really interesting about the Gartley pattern is how it ties in with Elliott wave and WD Gann. As I mentioned, this WX leg on the way down can look very much like a Elliott wave 5-wave sequence. And what I've done here is I'm showing you the Australian dollar spot market on a 15-minute chart. But of course you can't see the bars. But I have a traditional Gann box here on the left, and I've reflected it onto the right side of the screen here. So I have two boxes, and I just wanted to show you how cool it is where the Gartley pattern and Elliott wave and Gann all kind of mesh together here, because if you're an Elliott wave guy, you look at this and say here's wave 1, 2, 3, 4, 5, and then if this is newly established trend going in the opposite direction, there's the XA move as the newly established trend, and then we have a correction against that trend. That would be AB, BC, CD, or ABC in Elliott wave terms, and we're expecting perhaps a bounce off of this D point. And isn't this cool the way that it really conforms not just Elliott wave and Gartley but also to these Gann boxes here too. So let's summarize what we've looked at. H.M. Gartley wrote a book in 1935 entitled Profits in the Stock Market, and today people refer to a Gartley pattern, but it's very different from what he described in his original book. For that reason, when I wrote the Gartley trading method, I found it necessary to break the Gartley pattern down into two categories. Number 1, trend reversal Gartley. Number 2, trend continuation Gartley. The trend continuation Gartley is typically what people refer to as a Gartley pattern today, because that Gartley pattern does not include Gartley's original WX leg, even though he didn't call it the WX leg, he called it the AB leg, but to conform with the current labels, I call it the WX leg. And the other thing that's missing from today's Gartley patterns are the volume rules. So there's two types of Gartley patterns, a TCG, which is the trend continuation Gartley, and a TRG, which is the trend reversal Gartley. The trend reversal Gartley is obviously going to be more difficult to find because it's more stringent with its rules regarding volume and the WX leg. However, it is one of the best trades out there. So what we're going to do now is look at some examples in Market Analyst of finding TCGs and TRGs.